It's not just the eastern United States that's been paralysed by freezing temperatures and a huge blizzard, as the stock's bull market has also remained frozen in a trading range, which has most recently seen the Dow bounce off its icy cold extreme low end of the range, which according to the bear market doom and gloom growing consensus just marks the first bear market counter trend rally of 2016. Whilst my consistent view to the consonance of many has been that the stock market is undergoing a major correction, which this interim analysis seeks to evaluate ahead of my pending in-depth analysis that will seek to map out a detailed trend forecast for probably the whole of the remainder of 2016. So, does the stock market's bounce mean that the bottom is in, or is there further lower to go? Let's find out. Given the barrage of bearish emails and comments on our YouTube channel, it can be tough to continue to sustain consistency of expectations to instead succumb to the flip-flop mentality on every dip or rally, especially when literally everyone is screaming bear into my ear hole. However, I don't tend to pull my forecast out of thin air. Instead, I follow a time-tested, laborious process of in-depth analysis that reveals pieces of the puzzle, of which my most recent in-depth analysis was of the crude oil price, which concluded in a detailed trend forecast for the crude oil price bear market to have made its final bottom by early February 2016 and then embark on a bull market that would target a trend towards a late year high of $60. The overall picture being painted by this analysis is expectations for three trading ranges that would act to step the crude oil price higher during 2016. For instance, the current bottoming range followed by a second retesting range and then the third breakout range. Therefore, my forecast conclusion is for the crude oil price to trade within three distinct trading ranges for 2016 of $20 to $40, $35 to $50, and $62 to $40. Furthermore, the trend pattern imposed onto the trading ranges implies that a bottom is likely by early February 2016 at around $25, followed by a trend higher into mid-year towards $50, correction into September, and then followed by a trend towards $62 before succumbing to a correction during December to target an end-year price of approximately $48 as illustrated by the graph. The bottom line is that the current oil price collapse is a wake-up call to all major oil producers that crude oil as an energy source is running out of time. So whilst there may be future oil price spikes, however, the long-term trend given the likes of climate change is for the oil age to go the same way as the previous ages, such as the Stone Age and the Bronze Age and the Iron Age. So it will be for the oil age, which means nations such as Saudi Arabia, regardless of price, understand that they need to get as much as their oil out of the ground as possible and sold off before they run out of customers. The crude oil price forecast implications for the stock market in terms of any correlation between oil and stock price trends, i.e. when the oil price rises, do stocks tend to rise or not? Or is the relationship more inverse, i.e. a falling oil price is definitely a net economic boom for the most major Western economies, given the fact that their level of oil consumption tends to be far greater than any production, and thus a falling oil price acts to cut import bills and boost consumer spending as the cost of travel falls, resulting in more cash in the pockets of ordinary consumers. Against this, we have the negative impact of the oil sector companies in distress that ripples out to other sectors that acts to destabilize financial markets, i.e. precisely what we've been witnessing so far this year. Firstly, what stands out is that there is a strong correlation in swing between the oil price and the stock market, but not trend. And if the oil price is swinging lower, then the stock market usually also soon starts to swing lower, as the oil price tends to lead the stock market swings. Also, it's not a case of if the oil price falls today, then the stock market will also fall on the same day. Direction only tends to occur about 50% of the time. Conversely, when the oil price is swinging higher, then the stock market will tend to swing higher too. Of course, this is not an iron-cast 100% rule, for at the end of the day, it's just one supplementary intermarket indicator. The Goldilocks oil price range for stocks appears to be between $112 and $75, a range that we are unlikely to see a return to anytime soon, i.e. for the whole of 2016, so implies relative weakness for stocks. And secondly, a falling oil price is a net positive for the general stock market indices, up to a point that appears to be around $40, below which the stock market appears to lose some touch with reality and perceives the drop below $40 as the harbinger of economic and thus stock market doom, which actually does have some fundamental basis, i.e. loss of demand due to loss of economic activity and implications for the heavily indebted energy sector, pulling the general stock market indices lower. So where the stock market is concerned, $40 appears to be the key level below which we see what we have been witnessing in terms of trend weakness, whereas the closer the oil price gets to attaining $40, the more calm we are likely to witness and strengthening trend, which, given my forecast for oil price low by early February 2016, implies that we are now within a 2 to 3 week window for the stock market to bottom out. So whilst we are probably in for a bumpy ride over the next few weeks, however, according to the oil price swing correlation, it's not all doom and gloom once the oil price starts to gravitate towards $40, which, given the last price of $32, may not be that far off. Conversely, one needs to watch for deviation from the oil price trend forecast as a harbinger for stock market strength or weakness going forward, i.e. $20 or even $10 is going to result in a very bloody stock market chart. So do bear in mind, as some need to be reminded that the trend forecasts are the conclusions of what I deem to be the most probable following in-depth analysis, and not some prophetic utterances from a man-god deity. And as for my quick stock market technical tape, what jumps out from the chart is the recent bounce of the August low. But can it hold? Well, the decline into the low was pretty severe, which technically means it's unlikely to hold, which means that the stock market is in a larger corrective pattern that began off the May 2015 high, which is a pretty lengthy corrective pattern in terms of time, i.e. from May to February, which has acted to unwind much bullish sentiment to the point where even many of the former bulls are now fully fledged bears, probably reaching their most vocal just as the stock market puts in its bottom. The MACD. Additionally, the MACD is in the process of bottoming out from an extreme low, which also confirms that further downside should be very limited. And the bottom line is that the oil price trend and the stock market's oversold state are converging towards a stock market bottom that should carve out a final bottom for 2016 in a time window that probably only has another 2 to 3 weeks to run. So whilst it's probably not going to look pretty, i.e. the last low of 15,500 looks likely to break, however, given the oil price trend forecast, then it should form the end of the stock market correction and herald a resumption of the stock's bull market. Again, this is an interim analysis in response to much reader requests for an update in advance of my in-depth analysis that will conclude in a detailed trend forecast for the whole of 2016. So ensure you're subscribed to this YouTube channel for notification of your last bull standing analyst.